Hello, everybody. This is Matt Harbert, the Chief Investment Officer here at Instrumental Wealth. Today, I'm going to discuss a couple of investment strategies, specifically top-down and bottom-up portfolio construction. So what is top-down and bottom-up investing? These are two approaches that investment managers use to construct their portfolios. Both approaches can be effective, but they are distinctly different strategies that can result in very different-looking portfolios. With top-down investing, that's a strategy that takes a big picture approach. It involves analyzing the overall economic conditions and market trends to identify investment opportunities. Investment managers who use this approach will typically start by looking at macroeconomic factors such as GDP growth, inflation, and interest rates to determine the overall health of the economy. They will then do an analysis of different asset classes such as stocks, bonds, and commodities, or styles like growth and value, in order to identify regions, sectors, and styles they believe will perform well. Some advantages of top-down investing is that it allows investors to take a broad view of the market and identify trends that may not be visible at the individual company level. This can be particularly useful in times of economic uncertainty, when individual companies may be more vulnerable to market volatility. On the other hand, bottom-up investing is a strategy that involves analyzing individual companies and their fundamental characteristics to identify investment opportunities. Investment managers who use this approach will typically focus on factors such as a company's financial statements, their management team, growth projections, partnerships, or innovations. The advantage to bottom-up investing is this allows investment managers to identify undervalued companies that may not be reflected in the overall market. By focusing on specific characteristics of individual companies, managers can potentially identify hidden gems that are overlooked by the broader market. When comparing the resulting portfolio, an important difference is how each of these strategies allocate assets among different regions and sectors. With a top-down strategy, allocations are selected first based on the manager's macro views. Securities are then selected, used to fill in those allocations. In a bottom-up strategy, managers care only about finding the best companies. They don't care where they're located or what sector they're in. So the allocations to regions and sectors are not decided upon, but they're actually just a result of the stocks they've selected. In practice, the majority of managers use a combination of top-down and bottom-up strategies. They create a portfolio with good diversification and risk control from using the top-down factors to allocate the portfolio. And then they invest in companies that have greater conviction by focusing on bottom-up fundamentals. Here at Instrumental Wealth, we research potential managers to use in our client portfolios, and we pay close attention to which of these approaches they use and evaluate how well they employ the strategy. Our portfolios include a mix of managers using each of these strategies. And if you have any further questions on this, feel free to reach out to us through our social media pages or go to our website at instrumentalwealth.com and schedule a meeting with one of our advisors. Thank you, everyone, and have a great day.